Hey traders, in this video we're going to be looking at a couple of case studies I did recently on Goldman Sachs, and it was a double calendar and a double diagonal where we compared the two. So let's get stuck into it. So I frequently get asked about double calendar spreads and double diagonals. So back in early May 2018, I did a case study using Goldman Sachs. I chose Goldman because they had earnings set for July 17th. With both double calendars and double diagonals, traders sell front month options and buy back month options. They're both essentially volatility plays in that they are long Vega, but there's an added complexity in that we are trading two different expiry months on the volatility curve. Being short the front month options, we want front month volatility to drop and back month volatility to rise or at least stay steady. That's why looking at earnings dates can be important. In the following case studies, we were short the June options, which expired before the earnings announcement. The July options held their value due to the earnings announcement falling within that cycle. So here's the double diagonal trade setup. You can see on the put side, we're selling the June 220 puts and buying the July 215 puts. And on the call side, selling the 245 calls and buying the 250 calls. Net debit on the trade was 175. And the total capital at risk was 675. You can see above that we're actually paying less in implied volatility for the July put options compared to June. You see that we're buying 24% IV and selling 24.40 IV, so it was a good setup. The below payoff diagram shows the two profit peaks at 220 and 245, which was 5.75% below and 5% above price at the time, which was 233.41. The profit potential at the midpoint of the graph was around $90, which represented a 13.33% return on the 675 capital at risk. So you can see we had a bit of margin for error either side. What we didn't want, even though we want sort of volatility to rise, it's a long Vega trade. You can see we don't want the stock to drop 5 or 6% early on in the trade. We don't want it to rise 5 or 6% early in the trade either. We still want it to stay fairly steady. But we want the volatility and the time decay on those front months to really work for us, while the time decay and the volatility on the back month stays a little bit steady. Delta is basically flat, 0.36. Vega is positive, 1639, and Theta is also positive at 361. So you can see Vega is the biggest driver of the trade initially, but a rise in volatility won't necessarily benefit the trade. It depends on how the volatility rise impacts the different expiry months. For example, if the June and July implied volatility rises by the same amount, the net benefit to the trade will actually be zero. So again, we want the June options to decline in implied volatility. We want the July options to rise or stay steady. All right, let's compare that to the double calendar. So with this one, I had to go a little closer with the strikes. Otherwise, the middle of the payoff graph sagged too much, and there wasn't much profit potential in the event of a flat market. You'll see that in a couple of slides' time. So instead of being short the 220 puts and 245 calls, for the double calendar, we're short the 225 puts and the 240 calls, which means a narrower profit zone. With double calendars, because we're trading the same strike price, the max loss is contained to the amount of capital required to place the trade, in this case 493, so a little bit less capital at risk in this example. So you can see here, selling the June 225 puts and buying the July 225 puts. So that's our put calendar. And then on the call side, selling the June 240s, buying the July 240s. Net debit's 493, and that's the most we can lose on the trade. The payoff diagram below shows a similar but slightly different shape to the double diagonal. There's less of a dip in the middle, so the profit potential in a flat market is a bit higher. The trade-off is that we had to bring the short strikes in a bit closer. And this is what the trade would have looked like if we had left the short strikes at 220 and 245. So not a great looking payoff graph there, I think you'd agree. Okay, so that's why I had to bring them in a little bit closer. In terms of the Greeks on the double calendar, they're pretty similar to the double diagonal. So there's not going to be a huge difference in the trades, at least initially. You can see their delta's pretty similar, Theta, Vega, pretty similar to those numbers we looked at before. Okay, let's go forward to June 5th and check out how the double diagonal was doing at that point. It had made a nice profit of $55 per spread, or about 8.16%. So $55 may not seem like much, but remember, we're just trading one contract here, which was only $500 or $600 capital at risk. Bigger traders might be trading, 5 or 10 contracts. 10 contracts, you'd be risking, say, 6,000 and would have made 550. So pretty good percentage return at 8.16. And if we compare that to the double calendar, this position is actually doing slightly better and is up $70 or 14.2%. Remember, this trade had a slightly lower margin requirements, resulting in the better percentage return. So interesting couple of case studies there. Hope you enjoyed those. Thanks for watching. And I hope you enjoyed this tutorial today. And if you want to learn more about how I trade and analyze the market, just check out my website, optionstradingiq.com. If you scroll down a little bit on the homepage, there are a couple of free courses for you. The Iron Condor course will take you through all the theory of how to trade iron condors, as well as my full trading approach and other tips and tricks, including how to adjust. Same thing with the butterfly course that you can download there. Lots of good info, all free, if you want to learn about butterfly spreads. So thanks for watching, and I wish you good luck and good trading. If you have any questions, please leave a comment below. And if you've enjoyed this video, please hit the like button, and that way I'll know that this video resonated with you and I can produce similar videos for you going forward. All right, take care, guys. Talk to you soon.